Johnson & Johnson, J&J. They hold one of the most, well, powerful corporate titles you can get, a prime AAA credit rating.
It's incredibly rare. Only one other U.S. company has that right now.
Exactly. And you add to that, 60 straight years of dividend increases, a massive $17.2 billion R&D budget every year, and they just dropped over $30 billion buying up competitors.
Right, trying to fuel that future growth.
You'd think this thing is an absolute fortress, a stock that should be, flying high. Yet our deep dive today, based on a pretty comprehensive 7-chapter research report, finds something surprising about the valuation. At $188.64 share as of October 6, 2025, the market's basically saying it's fairly priced, not a bargain.
Yeah, it's holding back.
So why? Why the caution on what looks like such a titan?
Well, it really boils down to this dual threat, and it's pretty significant. First, you've got the looming patent cliff. Stelara, their huge immunology drug, is facing that loss of exclusivity. That's a big revenue hit.
Okay, the patent cliff.
And second, you have the decade-long shadow of the talc lawsuits. Billions in potential liability and management's legal strategy to contain it. That controversial Texas two-step. It's been rejected by the courts. Twice.
Twice. So massive uncertainty there, too.
Exactly. Sticky liability.
Okay, so that's our mission for this deep dive. We want to quickly unpack the bull case, the fortress J&J, but also really get into those bear risks, especially looking at J&J after spinning off its consumer health business, Kenvue. We want you to be fully informed on what's driving this healthcare giant right now.
Let's get into it.
All right, let's start with part one, the core foundation. We'll look at the business itself, the management, and the financials.
Cooking off with Chapter 1, business analysis. And you hit on the key point already. This is the new J&J. The Kenvue spinoff in 2023 was huge. They shed the consumer brands, Band-Aid, Tylenol, Listerine, all that stuff.
Right, Kenvue's its own company now, so J&J is left with
two core areas, both high growth, high margin. First is Innovative Medicine. That's the pharma division. It's about 65% of revenue, pulling in around $57 billion in 2024 sales.
And that's where the blockbusters live, like Darzalex for cancer. I saw that hit $3 billion in quarterly sales.
Yeah, phenomenal growth there. But it's also where Stelara sits, the big immunology drug facing that patent cliff we mentioned, and Tremfya, another key immunology drug.
Oh, okay, Innovative Medicine. What's the second part?
MedTech. That's about 35% of revenue. Over $30 billion in sales. And this is really where they're focusing future growth efforts, especially through acquisitions. We're talking high-tech medical devices.
Like those robotic surgery systems.
Exactly. Things like the VELYS robotic-assisted surgery system, primarily for orthopedics right now, and the VeriPulse platform for cardiac procedures, specifically treating atrial fibrillation. It's about advanced integrated solutions for hospitals.
It's striking how dominant they are, even in these focused areas. The report notes over 75% of their sales come from products that are number 1 or number 2 in their global market.
That market leadership is critical. And it all circles back to that financial fortress status, that AAA credit rating.
Explain that a bit more. Why is AAA so significant?
Well, it means J&J has the absolute highest credit quality possible. Lenders see them as extremely low risk, so they get the best borrowing rates, the easiest access to capital. It's a massive competitive advantage, especially when you're doing multi-billion-dollar deals.
So when they go to buy a company like Shockwave Medical for $13 billion, high interest rates don't hit them nearly as hard as they would, say, a smaller competitor with more debt.
Precisely. It gives them flexibility and firepower that few companies on Earth possess. It underpins their whole strategy.
And they often tie this back to their company philosophy, right? The credo.
They do. It's foundational, written way back in 1943. It explicitly states the first responsibility is to patients, doctors, and nurses. Stockholders come later in the list. They argue this long-term focus is why they have such stability and trust.
Interesting link between ethics and finance there. Okay, let's pivot to the people making the decisions. Time for Chapter 2, Management Evaluation. The focus here is on CEO Joaquin Duato, who took over in 2022.
Duato's record is, well, it's kind of dual-sided, as the report highlights.
How so?
On the positive side, he's credited with leading a, quote, dramatic turnaround in the pharmaceuticals division before he became CEO. And he was deeply involved in steering the company through the development of their single-shot COVID-19 vaccine. That was a huge undertaking.
Okay, significant wins there. What's the other side?
The complicated side is definitely the ongoing talc litigation and the strategy used to handle it. His leadership tenure is really defined by this aggressive push for the Texas two-step.
Explain that again briefly. What is the Texas two-step?
It's a legal maneuver where JNJ created a subsidiary, LTL Management, put all the talc liabilities into it, and then had that subsidiary declare bankruptcy to try and force a global settlement on specific terms.
But you said it failed.
Twice. Federal courts rejected it, basically saying you can't use bankruptcy this way just to shield the parent company's assets when the parent company isn't actually in financial distress.
So attempting it twice, that sounds persistent, maybe even stubborn. What does that mean for the company now?
It means the ultimate cost of settling potentially tens of thousands of talc claims is still a huge unknown. The attempt to cap the liability failed, so the final number could be substantially higher than what they tried to ring-fence. It's a major overhang.
And does that uncertainty maybe explain the big shift in how they're using their cash?
It seems directly related.
Yeah.
You look at capital allocation, they've dramatically pulled back on share buybacks. Peak was like $6.7 billion back in 2019. Last 12 months, only $1.5 billion.
Where's the money going instead?
M&A. Aggressive M&A, specifically in medtech. They've spent over $30 billion in roughly 2 years just in that space. Think of Biomed, the heart pump company, for $16.6 billion, and the proposed deal for Shockwave Medical at $13.1 billion.
They're essentially buying growth engines.
Exactly. Management explicitly says, we think in decades. They're using that AAA balance sheet to acquire future revenue streams, likely trying to offset both the talc uncertainty and that looming Stelara patent cliff.
But through all the spending, all the legal drama, the dividend remains untouched.
Absolutely sacred. J&J is a core dividend aristocrat. Over 60 consecutive years of increasing the dividend. The current yield is around 2.76%. For many long-term investors, that is the primary reason they hold the stock. That commitment seems unshakable.
Okay, let's put some hard numbers on this foundation. Moving to Chapter 3, financial analysis. Give us the snapshot again.
Sure. As of October 6, 2025, market cap around $454 billion. Trailing 12 months, TTM revenue is $90.6 billion. And the TTM price-to-earnings ratio, the PE, is 20.2.
And you mentioned earlier the engine behind the M&A and dividends is free cash flow. How strong is that, really?
Exceptionally strong and incredibly consistent. Over the last 5 years, J&J has reliably generated between $18 billion and $20 billion in free cash flow annually.
Wow, $18 to $20 billion a year, just cash left over after running the business.
Yeah, that's the fuel. That FCF pays for the dividends, the R&D, the acquisitions, everything. That's why they can support that AAA rating.
And profitability.
Very healthy. Gross margin is hovering around 68.4%, operating margin around 25%, and the balance sheet strength is clear low debt-to-equity ratio, about 0.50. It reinforces that whole fortress idea.
How does that PE of 20.2 stack up against competitors?
It's actually slightly higher than the average peer PE, which the report pegs at 18.6x. So the market is giving J&J a premium, likely for that quality, that stability, that consistency we've been talking about.
But maybe not a huge premium given the risks.
That seems to be the case. And it's reflected in the intrinsic value estimate from the discounted cash flow, or DCF model in the report.
What does the DCF model suggest?
Based on reasonable assumptions like a 4.9% short-term growth rate and a 9.0% discount rate to account for risk, the estimated intrinsic value falls in a range. $175 per share on the low end, $205 per share on the high end.
And the current price is $188.64.
Right smack in the middle. It tells you there's significant disagreement out there about how those risks, Stelara, talc, the new pressures, will ultimately play out versus the strength of the core business and the M&A strategy. It's price for uncertainty.
That leads us perfectly into part 2, external forces and the verdict. Let's see how the market is grappling with this. Starting with Chapter 4, market sentiment. What are the analysts saying?
Well, the official consensus rating is a moderate buy.
Sounds okay, right?
Yeah, sounds positive enough.
But then you look closer. The average 12-month price target range from analysts is pretty telling. It's between $176.11 and $188.88.
Well, the top end of the average target is $188.88. That's basically where the stock is trading right now.
Exactly. So analysts are saying moderate buy, but their price targets imply almost zero near-term upside from the current price.
That seems inconsistent. How do you interpret that? It suggests they see the company as high quality, probably safe, hence the buy rating. But fundamentally, they think it's fully valued right now, factoring in those imminent risks. Limited growth expected in the next year.
Interesting disconnect. But what about the stock's actual movement? How's the technical picture?
That's the other side of the coin.
Yeah.
Technically, the stock shows strong bullish momentum. It's trading comfortably above both its 50-day and 200-day simple moving averages. Price action looks positive.
So fundamentals say fairly priced, limited upside, but technicals say momentum is bullish.
Yeah.
Weird.
It is a bit of a head-scratcher. Adding to the positive technical feel, though, is the short interest. It's incredibly low, only 0.92% of the float.
Meaning very few investors are betting against the stock price going up.
Right. It reflects strong institutional confidence in the stock's stability, at least. They don't see a collapse coming. The media narrative sort of mirrors this split, too. Lots of positive buzz about the acquisitions and pipeline developments, but constantly balanced by those nagging headlines about the talc litigation.
Okay, let's look at who actually owns the stock. Chapter 5, ownership structure.
This is dominated by institutions. About 74% of JNJ shares are held by large institutional investors.
Like pension funds, mutual funds?
Exactly. And significantly, the biggest holders are passive index funds. Vanguard, BlackRock, State Street, together they control nearly 25% of the company.
What does that passive ownership mean for the stock?
It creates a really stable price floor, as the report calls it. These index funds have to hold J&J because it's a major component of benchmarks like the S&P 500. They aren't actively trading it based on near-term news. That provides a lot of underlying support.
Okay, stable institutional base. But what about the people running the company? Insiders.
That's the critical counterpoint here. Insider ownership is tiny, just 0.61%. And more importantly, the pattern of the last 6 months is one of consistent selling by executives.
Selling.
Yes, and crucially, there have been no open market purchases by insiders during that time.
Okay, insiders might sell for lots of reasons: taxes, diversification, buying a house.
True. But they generally only buy their own company stock on the open market for one reason. They believe it's significantly undervalued.
And the fact that there's been no buying.
It strongly suggests that the people who know the company best do not currently see the stock as a bargain at these levels. That lack of insider conviction is a pretty important signal, especially for value-oriented investors looking for that margin of safety.
It paints a picture of stability, but maybe not immediate opportunity. Let's broaden the view now to external pressures in Chapter 6. Risk assessment. We know the internal strengths: AAA rating, R&D, scale and weaknesses, Stellar cliff, talc overhang. What are the big outside threats?
Well, beyond those company-specific issues, J&J is facing what the report calls a regulatory and geopolitical pincer movement. It's squeezing them from two directions.
A pincer movement. Okay, break that down.
First, you have the revenue squeeze. The Inflation Reduction Act, the IRA, is a big one. It gives the U.S. government power to negotiate prices on high-cost drugs covered by Medicare.
Affecting drugs like Stelara or Darzalex eventually.
Potentially, yes. It puts a structural cap on future price increases and revenue potential for their most successful pharma products. It limits how much they can charge down the line.
Okay, so revenue growth gets squeezed by regulation. What's the other side of the pincer?
Costs. That comes from geopolitical factors. Specifically, the planned 2025 U.S. tariffs on certain medical products imported from China, things like syringes, needles, various electronic components used in their MedTech devices.
So input costs are going up because of trade policy.
Exactly. It directly increases their cost of goods sold, particularly for the MedTech division they're investing so heavily in.
I see it now. The IRA is pushing down on potential revenue while tariffs are pushing up on costs.
That's the pincer. Inflation generally, plus specific regulatory IRA and geopolitical tariffs pressures, are combining to compress J&J's profit margins from both sides. Even a fortress like J&J isn't immune to these macro forces.
That really contextualizes why the market might be hesitant, despite the AAA rating. Okay, let's bring it all together. Chapter 7. Conclusion. Let's restate the bull case clearly.
The bull case is straightforward. J&J is a world-class company, financially impregnable with that AAA rating. It has a newly focused strategy after the Kenvue spinoff. Management is smartly using the fortress balance sheet to buy future growth via MedTech M&A. It's durable, defensive, and has that unwavering commitment to the dividend.
Solid bull case. Now, the bear synthesis.
The bear case says the risks are significant and, importantly, immediate. The Stelara patent cliff isn't some distant threat. It's happening now. The talc litigation cost remains a multi-billion-dollar question mark thanks to the failed Texas two-step. And those external pincer pressures, IRA, tariffs are actively compressing margins today. The market, bears argue, has already priced in all the good news, the stability, the M&A potential.
Which leads back to the valuation verdict.
Yes. At $188.64, J&J is trading right within that estimated intrinsic value range of $175 to $205. It's a world-class company, no doubt, but it's being offered at what appears to be a fair price, not a bargain.
So no obvious discount, no significant margin of safety for value investors at this specific moment.
That seems to be the conclusion of the analysis. You're paying a fair price for quality and stability, but you're also taking on those near-term revenue and liability risks without much of a discount cushion. The wide 175-205 range really reflects an uncertainty. Bears see $175, bulls see $205, and the market sits right in between.
So thinking ahead, the report leaves us with a final thought. Given J&J's big bet on medtech, particularly these integrated platforms like the VELYS surgical robot, the key question for you, the listener, to consider is this.
Can J&J build switching costs in medtech fast enough? Can they lock hospitals into these expensive, integrated ecosystems with all the training and system compatibility involved quickly enough to offset the very real, very immediate financial hit coming from the Stelara patent cliff?
That ability to create sticky customer relationships on the medtech side, that seems to be the deciding factor on whether J&J can break above that $200 high-end valuation in the coming years.
It's the core strategic challenge they face right now.
A fascinating case study in navigating risk and transition. If you found this deep dive valuable, please like and subscribe to the Stock Analytics AI YouTube channel. Our members, at $4.99 a month, get priority access to deep dives like this one.
And over the next few months, we're planning to cover all of the S&P 500 stocks, so members get first dibs on which tickers we analyze next. Or, if you want a specific company covered, just drop us a super thanks on YouTube.
And finally, the necessary disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.